Thank you both so much for joining us here today. To set the context, Kyung-Ah, you oversee ESG investment management at Temasek, Singapore's sovereign wealth fund investing on behalf of future Singaporeans. And Andy Siwo, overseeing climate solutions investments and sustainable investments for New York State Common Retirement Fund, investing on behalf of over 1 million, I believe, pension plan participants. So first, just describe just a little bit about how your job informs sustainable investment decisions on behalf of your funds, and maybe what has changed in the last year that allows you to do so more effectively. And Kyung-Ah, let's start with you.
Yeah, well, good afternoon. It's a real pleasure to be here. I'm going to take a little bit of liberty to broaden the question and start with the second part of it, and then talk about sustainable investing at Temasek. So look, we are in a very different world, right, in terms of the volatility, the uncertainty, and complexity. And we see that playing out during the course of the past year in terms of the macro environment, where we are higher for longer, as well as growing fiscal deficits and liquidity constraints. And then, of course, the politics, right? We are in a very big election year, and you are seeing the translation of dissatisfaction and populism into votes. And of course, the growing geopolitical tension and the unfortunate crisis that is playing out. And so it is translating into volatility around capital flows and sustainable investing, as well as there are pockets of investment activities that is more challenging because of the higher cost of capital. And in your opening remarks, you also mentioned some of the political headwinds. Having said that, I've been a practitioner in this market for now almost 2 decades, so I'm showing my age. And I've lived through the volatilities of Clean Tech 1.0, the GFC, the COVID, et cetera. And I would argue that the fundamentals around sustainable investing is actually very much intact and actually becoming stronger. And you see this on the policy front, where green is now intertwined with industrial, economic policy. You also see this with many technologies, where we are seeing more and more of a virtuous inflection point, and the economics, importantly the economics, where it is going hand in hand with risk and return. And Temasek, as you said, we are a generational investor, and so sustainability is the core of everything we do, and with the benefit of looking at it longer term. And let me give you, a couple of examples of what this looks like in practice, both as it relates to how we invest and then how we integrate. So on the investing side, we are increasingly aligning investment activities to what we view as very durable key structural trends, and there are 4 of them, one of which is sustainable living. And it comprises investments into companies that have products and services that actually contribute to and advance the pathway towards net zero, more and more so around nature positive as well as inclusive growth. In addition to that, we are selectively investing into climate transition investments, and these are companies in high-emitting sectors that we believe actually have very tangible transition plans that they can execute upon, and with that capital, it brings certainty as well as additionality, right? So that's on sustainable living investments. In addition to that, we are integrating environmental social governance considerations across all of our investment, regardless of whether it's sustainable living or not. And it can look different across transactions, given we take a materiality lens. However, there are cross-cutting considerations that we think are very important, and climate risk and opportunity is certainly one of them. As an example, we apply an internal carbon price for all of our new investments. And over the past year, we've actually increased that from $50 per ton to 65, and we will increase it gradually to $100 per ton by 2030, taking into consideration that we need to take greater climate action and making sure that we are aligning towards a Paris pathway. And hence, that's what's an example of what's changed over the past year. Post-investment, we are also taking a much more targeted engagement approach. And as an example of what's changed, we are much more methodically applying what we call a climate transition readiness framework, where we are assessing some of our biggest exposed companies on this framework on what good transition looks like, and then taking a targeted engagement approach. And again, part of the reason for this is it's very much about risk management, but also value creation. And we have to now take concrete action and not just have targets and aspirations. So that gives you a bit of a flavor of how we're actually advancing this.
Thanks, Kyung-Ah. I want to come back to the utility of transition plans in a bit, but Andy, question over to you, same thing.
Yeah, I'm delighted to be back and appreciate the invitation. The New York State Common Retirement Fund aims to maximize returns at a prudent level of risk for the sole interest of pensioners. There are about 1 million members each month that we pay in a collective $1 billion of benefits. These include janitors, crossing guards, teachers, firefighters. There's no higher objective than protecting retirement assets. And our fiduciary duty is sacrosanct and forms the basis of our investment decisions. It may be useful to share that fiscal year 2023 figures will soon be released. Our fiscal year happens to end March 31st, so that is fortuitous for us, given the resilience of the markets in the first quarter. So when those results are released, they should be satisfactory. Though I will share the results from our previous fiscal year. Our 3-year net return for the fund was just shy of 12%, which is twice our 5.9% assumed rate of return. 10-year return was just over 8%, and our funded ratio is north of 90%. And these results make the fund one of the best performing pension funds in the country, certainly one of the top, with assets north of $250 billion. In 2021, the Federal Reserve released a research piece titled Climate Change and Financial Stability, and posited, quote unquote, that risks arising from climate change can affect financial stability. Some of these risks include disruptive supply chains, rising insurance costs, unstable earnings. More specifically, last year, as many of you know, from a climate perspective, was the hottest year in terms of temperature recorded, and many believe that this year we will eclipse that record July 2023 temperature. The world's population has grown from about 2 billion in 1923, 100 years ago, to 8 billion today. And population growth has led to more stress, more economic stress, more social stress, more environmental stress. And the confluence of these stresses in the last year notably has strengthened the case for sustainable investments.
And Andy, for you, the fund put out its climate action plan 5 years ago, right? And that stood up the unit that you're now leading. You started off with a $20 billion commitment to sustainable investments. You reached that early, so you've committed another $20 billion by 2035. Can you talk a little bit about how that first $20 billion was allocated, and if there's anything different or notably changing in your thinking around the next $20 billion?
Sure, great question. So New York State Comptroller Thomas Napoli is the sole trustee of the fund, and as you referenced, we released a climate action plan in 2019. And in that climate action plan, we set a target of committing $20 billion to sustainable investments. That figure has since been raised to $40 billion. How that has been invested, we invest, what we consider sustainable investments, investments that advance one or more of our 9 sustainability themes. We have 9 themes that are split equally into 3 categories: human rights and social inclusion, economic development, and then resources and environment. We have a particular focus on climate change. Of the existing $22 billion that we've committed, roughly 70% of that has a climate orientation to it. Now, the next $20 billion will be committed very carefully. Table stakes have risen. We are in a different interest rate environment. Some opportunities will be appealing, some will be less appealing. We will be committing more capital to climate index strategies. We'll be committing more capital to green bonds. Real estate, real assets seems quite interesting. Commercial rate impact investments as well. And there will be areas that we find less appealing as well.
And Kyung-Ah, Temasek's got a 2030 goal to halve its emissions from a 2010 level, portfolio emissions. Can you talk a little bit about the journey as we've got however many years left to 2030, and maybe how a couple of things you touched on before, your internal carbon price affects some of the decisions, and also the importance of credible transition plans from many of the folks in this room who maybe spent this morning with series going into how to craft those?
Yeah, absolutely. Look, it is a very ambitious target, right? Because several years ago when we actually set it, our portfolio emissions was at 30 million metric tons. And having a 2010 baseline means we have to get to 11 million metric tons. We only have, a few years left, so it is actually very ambitious. And there is no silver bullet because in many ways our portfolio is reflective of the real economy. So we got to actually take a systems-wide approach as well as what I like to say, radically collaborate. And let me give you the 3 key levers that we're leaning into. One, as I mentioned, is investing into the scale-up of green solutions that address pain points around the decarbonization. Certainly renewable energy, but as we deploy more renewable energy, you're seeing the challenges around intermittency, curtailment, grid, et cetera. And so we are investing into areas such as long duration storage, better battery materials and solutions that extend the range, but also enable sustainable materials that replace things like critical minerals and end-of-life solutions and so forth. We're also investing into hard-to-abate sectors, right? So we need to be able to do things like sustainable aviation fuel that is more feedstock flexible. We happen to own or be an investor in an airline, right? And it's done everything it can in terms of upgrading its fleet. It actually has one of the youngest fleet that has reduced fuel consumption by some 30%, but passenger travel is coming back to pre-COVID levels. And so we've got to figure out how to actually unlock SAF. So we are investing into SAF as an example. Same thing with the built environment. So we have a number of companies in real estate, and we're in New York City where the built environment is very much the biggest challenge and opportunity. And so we are investing into things like green steel, green cement, green hydrogen, and so forth, right? But we've got to figure out how to radically scale this and take it from the first of a kind to the nth of a kind and make it as infrastructure-esque as possible. And so this is where we are actually partnering. So an example of this is we have a JV with BlackRock where we formed decarbonization partners. We seeded it collectively with $600 million of capital across a series of funds, which is very intentional because we want to make sure it's durable as an asset class and a fund. And it's just closed its fundraising. So basically, it's crowded in like-minded investors, $1.4 billion fund. And it is going to actually invest into that late venture early growth and hopefully turbocharge the scale-up of these types of technologies. In addition to that, we've got to transition existing portfolio companies and really do the incumbent industry transition from brown to green, right? And we talked about some of the one-on-one engagement that we're doing. We are using the Climate Transition Readiness Framework, where again, it's not rocket science. We're drawing from TCFD, the Transition Pathway Initiative, and other frameworks to look at, what does good transition look like, and are these companies on the pathway, whether it's governance, organization capability, has it integrated into its core strategy, are they actually setting not only long-term science-aligned targets, but interim, near-term targets, are they actually aligning the CapEx expenditures against it, do they have KPIs and incentive linkage? These are not rocket science things, but they're hard to do. Right? So trying to keep our portfolio companies accountable and identifying where are they pain points where we can focus our engagement and the opportunities for us to partner with them and unlock some of these faster. So again, SAF is a good example where we partner with Singapore Airlines, which happens to be our investment company, the Civil Aviation Authority of Singapore, Neste, in really trying to figure out how we can operationalize SAF in Singapore, use sustainable aviation fuel credits to bring down the green premium, which I think is also very important, which I'll get back to, and then really be able to unlock this. And so on the heels of that, Singapore Airline basically is targeting 5% SAF. The government of Singapore came out with its SAF blueprint. So it's an example of how to actually unlock some of the different levers to get it going faster. And then the last lever is around enabling carbon markets. And I know there are many in this room that feel very passionate that we can't make it voluntary carbon markets a get-out-of-jail card, but it's not meant to be. It's complementing the hard work that companies and investors in the real economy is doing. But if you really believe that the time value of carbon is essential, which it truly is, right, we've got to unlock integrity around carbon markets and enable greater capital flow to avoidance as well as removal solutions, technology, but certainly nature-based solutions. And hence why we set up a platform called Gen Zero. You and I were talking about it behind the stage, which is a dedicated platform focused on carbon markets, tech-based nature, marketplace and exchange, and also enabling some of the climate finance to go to the global south.
Nice. Well, you've offered us some good things to think about before going into our Carbon Project Finance Forum that is tomorrow. One thread I want to make sure to pull on while we still have time here, the perennial question, or one of the perennial questions in sustainable investing is the to divest or to engage, if so, when, how, all the rest. New York State Common Fund earlier this year decided to both divest and restrict investments from, I think, 8 oil and gas companies. Can you talk a little bit about the decision-making path to get there, and do you more broadly see any kind of notable update on this perennial thread of to divest and to engage, and if so, how?
Thanks. Yeah, so there's a quote about if the only tool you have is a hammer, everything looks like a nail. I hope I got that one right. And so I think we resist the either-or narrative, and perhaps it's a both and. In the Climate Action Plan, we outlined 3 tools that we use. The first is identification and assessment. So there are areas of the market that we don't believe will be necessarily accretive in the future. And any investor will routinely exit investments that they believe are being held at, if the intrinsic value of an investment is less than its market price, it's appropriate to make a decision. The next is engagement and advocacy, and then finally investment and divestment. Our largest tool is engagement and advocacy. We own north of $1 billion in several stocks, so their success is our success. And engagement and advocacy, we do that across E, S, and G factors. So there's several areas that can drive value. So for example, diversity, equity, and inclusion, greenhouse gas emission disclosure, political disclosure, executive compensation, worker protection and safety. All of these issues are pretty germane to driving investment outcomes. And so we use the right tool for the right situation.
Yeah. And Kyung-Ah, any thoughts on the path that Temasek takes on making that decision of when to pull the lever when working with higher emitters in your portfolio?
Yeah, I mean, I'm very much aligned with what Andy said, right? Arguably, it's easier to divest your way out to meet your portfolio emissions, but it doesn't really do much for the real economy. And this is very much a real economy transition, and as you said, a global economic opportunity as well, right? And so we are working with our portfolio companies to do the hard work, even though we know it is quite challenging. And we have success cases where we can do well and do good. So for example, we have a portfolio company that is in power and urban solutions. A few years ago, they had a lot more conventional energy as well as offshore marine. Today, the majority of its business is actually focused on renewable energy and on sustainable solutions. And as a result of that, they have actually generated somewhere around 2 to 3 times market value, depending on which time horizon you look at. So it does show that you can build a resilient business, capture growth opportunity, and generate good impact as well as good value, right? And so we are trying to do that across all of our hard-to-abate sectors and make sure that we put them on the right pathway, and by doing that have real economy impact, right, and hold ourselves accountable. But it is a heavy lift, and this is where I do think systems as well as a radical collaboration approach is super important.
Yeah. Yeah, just avoiding portfolio emissions is like not checking the mailbox, hoping there's no mail in there, and I can tell you that doesn't work very well. Final question, since we've only got about a minute left. What is maybe one thing that you'd hope coming back onto a stage 1 calendar year from now you could look back on from both your particular remits and kind of elevate as a success on our path to 2030? And I'll start with you. Yeah.
Sure. Yeah. So this is a very interesting year, given that over half of the world's population is facing an election. And policies and incentives are very important. And that oftentimes depends on some of these outcomes. And so I hope that there are some good outcomes, and so we can enact good policies. So for example, the Inflation Reduction Act, I would say, is a multi-colored incentive in the sense that it benefits what some describe as red states and blue states and purple states. And so I am hoping that in the next coming years that we are able to move forward in that direction with the right incentives.
Awesome. Thanks, Andy. Any thoughts from you, Kyung, on our last couple seconds here?
Yeah, I mean, we are in a green fin conversation, so I'm going to basically say, look, we have COP29 coming up and COP30 next year, right? And there's a lot of focus around how do we mobilize greater capital flow. And the best way to do this is actually putting a price on carbon as well as moving away from the fossil fuel subsidies and redirecting it. So I'd hope that we make some level of progress on this, as well as have climate, as well as nature and the social inclusion agenda increasingly come together in a way whereby we hopefully can use this as an anchor for greater collaboration rather than bifurcation. So that would be my hope.
All right, well, we'll jump on that hope and carry it through the rest of today's program. We're at time, so we're going to have to end it there. Thank you, Kyung-Ah. Thank you, Andy, for joining us. Please join me in welcoming Kyung-Ah and Andy. Thank you so much.
Yeah,
All right. See you backstage.
Okay.
Thanks, Andy. Appreciate it.